central banks are extracting liquidity. It's factual. It's not. I'm not predicting here. It's an observation. It is a regime change. They are extracting liquidity from the system. They are not infusing liquidity into the system. We do have inflation around the world now.
On today's episode of the WTFinance podcast, I'm happy to welcome Neal Berger, who's president at Eagles View Asset Management. So, Neal, thanks for joining the podcast today.
Thank you for having me, Anthony.
No problem. So, during 2022, you performed quite well and had a stellar year. When you look at the markets, almost basically every asset went down. Lots of volatility, lots of uncertainty. So, can you maybe give us a little bit more insights into maybe why you performed well and what you were really looking at to get that performance?
Sure. So I think it starts with a view of what was going on in the market, for the dozen years prior to 2022, and why we ended up where we were at that time, which I like to use the word wackadoodle. I would say fucking wackadoodle. Actually, pardon my cursing. I don't know if you're allowed to do that on a podcast, but just $19 trillion of sovereign debt, trading at negative nominal interest rates, for example, German bonds trading at negative 70 basis points, where you have to pay the German government 70 basis points to hold your money, or, and that was true all over Europe and elsewhere around the world. That's nuts. I mean, there's just no rational explanation in any universe for why that's going to happen. Public equity valuations, private equity valuations, the proliferation of 18,500 cryptocurrencies, NFTs, Bored Apes, CryptoKitties, whatever the NFTs are these days. Even Rolex watches. Everything was pretty nutty, and had been building in that direction. And I'm in the observation business, right? So I'm observing these things. These are factual. It's not like I'm predicting them. That's what happened, and you're observing it in real time. And so the question becomes, well, why did it happen? Why are we where we are? If I'm thinking about when I started the fund in April of 2021, why were we sitting here having had a 100-year pandemic, where the global economy screeched to a halt, but yet the stock market went up like a rocket ship? I mean, why did all these weird things happen? And I could say from today till tomorrow, this is bizarre, this is weird. Most people don't care because most people are long something, right? So they're long the stocks, or they're long cryptos, or they're long something, and they think it's the norm. But in reality, it was quite the anomalous situation. And so when I thought about how did we get here? How did we get to this point where you've got like 20 basis points for US 2-year notes, which is a totally wacky condition. And the conclusion that I came up with is that, and I don't think it's such rocket science, is, the central banks globally injected $25 trillion of liquidity into the system, dating back, I'm going to be 55 this year, so I've been trading for over 30 years, but dating back to the global financial crisis in 2008, when the financial markets around the world were on the precipice of systemic risk, and they had to, there was rumors Morgan Stanley was going to potentially fail. Obviously, we saw Bear Stearns fail. AIG would have failed had it not been bailed out by the U.S. government. And so it was a scary time. And so what the central banks did was inject enormous amounts of liquidity into the system, kind of like when a patient is on their deathbed, injecting a ton of medicines or morphine or whatever you inject into someone who's sick to keep them alive. So they had to do that at the time. And this just gradually, kept the economies and the markets just were not healthy in terms of their risk-taking, attitudes towards risk-taking, and the leverage that was being used. And so they had to keep liquidity in the system to allow for the system to function. And so there were various attempts over the years for them to extract themselves from this unnatural position that they were in, being so dominant in the world of just basically owning every bond that nobody wanted. They were the buyer, and in exchange for giving them the junkiest securities that you have on your balance sheet. If you're a bank or a pension fund or whatever, they'll give you cash, right? And so it's like if you have a bunch of junk around your house and you don't know how to get rid of it and nobody wants to buy it, and along comes somebody and says, I'll give you top dollar for it, you clean out everything, and you get a lot of cash, right? And so when they tried to extract themselves from that unnatural position, the markets didn't like that, and you had situations in the early 2010s where they tried to do that, maybe 2012, 13, 14, I don't remember the exact date, but it caused was so-called the taper tantrum, where as soon as the central bank tried to extract itself from the market and extract the stimulus, the markets really went down in a big way, and political pressures at the time didn't allow them to continue on in that path, and they had to keep injecting liquidity into the system, always understanding that this is unnatural, that they're the largest non-profit motivated hedge fund in the world, where they're just literally buying up everything, and they're so influential and dominant that the whole world is the whole markets are all totally distorted by the central bank activities in the market. And so then but they always they were always uncomfortable in being in that position, that they were the market, they were just supporting everything. And so then there was always a desire to extract themselves, and then unfortunately along came the COVID-19 pandemic, and they not only could not extract themselves from the system, they actually had to add more liquidity into the system. And and if you look at a chart of, let's say, M2 money supply, which is not the ideal proxy for this, but it's as good enough for as anything. Look at the chart of M2 money supply versus the SPX. Since 2010, it's got a 98% correlation. So you can see, as money supply is increasing, you have the S&P rallying, and it basically mirrors itself. It mirrors very closely to 98% correlation. And so this was my conclusion as to why we were where we were, is that when you inject an ocean of liquidity to the tune of $25 trillion into the system, you're going to get collateral effects. And the first collateral effect was massive asset price inflation. And massive asset price inflation in itself doesn't bother central bankers. They're not trying to kill a bull market in Solana or Dogecoin or whatever you want to point to, but they are, and so they're not out to hurt people and just take the punch bowl away because they're mean people. The problem is that we saw and which is what one would expect, we saw a secondary collateral effect, and the secondary collateral effect was consumer price inflation. And now, you're a young guy. I'm gonna take liberties in saying you probably weren't even born the last time we had consumer price inflation in the early 1980s. I was in just graduating elementary school. So this thing called consumer price inflation, at least in the developed countries like the U.S. and Europe and Japan, was considered a unicorn. You've heard about this thing called inflation. I've never seen it. I don't know if it ever existed really. I don't know if it's just a rumor. I don't know if it's extinct, and structurally we've changed, and all kinds of theories. But the reality is that during most participants' lifetimes, who are investors now, we have never seen actual inflation, and we've got an inflation problem around the world. One could argue it's coming down a little, it's going up a little. Who knows? It's going to have its ups and downs, and But the reality is, we see it, and it's real. And whether you want to argue it's 6% or 5% or 7% in the U.S. or 10% in Europe or 4% in Japan, the fact is it's here. And again, this is not a prediction. This is not a guess. This is an observation. It's just factual. You can't argue with it. It just is what it is. And so this is what the central bankers had to respond to, in that they could no longer just kick the can down the road and say, yeah, I know the markets are crazy, negative 70 basis point German 10-year notes as a function of what we're doing, or, private equity valuations, or the SPAC craze, or, whatever you want to point to. We know it's nutty, but, we have no, that's the market. We have no incentive. So, once they saw that consumer price inflation was percolating, that's a dangerous thing. And it was like we went from like 2% consumer price inflation in the US to like 8%, like immediately. Like it wasn't even a gradual increase. We went from like 2 to 3 to 3.5 to 4 over a period of a long time. It literally jumped, right? And so, this concerned the central banks, and they were already in an uncomfortable position, being such a dominant force in global asset prices and in ownership of securities around the world, that this really pushed them over the edge, where they had to change their posture 180 degrees, from a liquidity infusion posture to a liquidity extraction posture. And so this is a regime change. I mean, and so like it or not, it's an observation, it's factual, that the central banks around the world changed their posture, really in 2021, although the markets didn't catch on to it until 2022. But the central banks changed their posture towards liquidity. In the US, they're politely calling it balance sheet normalization, where the Federal Reserve since September of last year has allowed $85 billion a month of fixed income securities to roll off their balance sheets without, re-upping. The European Central Bank since March, since just this month, 15 billion euros per month. So it's really just getting underway. And, it's when you're extracting, such an enormous amount of liquidity that you've injected into the system, they've got to do it in a manner that's gradual. They're not trying to, create market crashes or anything. And it's going to take lots of time and probably many, many, many years to, to get through this, what they're calling politely balance sheet normalization, which I'm calling extracting liquidity from the system that they had artificially infused into the system to, to support financial markets and to support the economy. And so if you believe, what I believe, and believed at the time and saw, was that the only reason that asset prices were doing what they were doing, and had been for many years, was that we had this massive liquidity infusion, and the central bank posture towards liquidity was towards infusion. And so you'd have people on TV, on CNBC, on Bloomberg, whatever it may be, and the reporter would ask about CPI or employment. I mean, it would have been nice to see someone go on TV and the reporter says, "Well, what do you think about CPI?" And they say, "I don't know. I don't care. It doesn't make any difference. The central banks are adding liquidity. Just buy the market," right? Or, what do you think? Oh, the COVID-19 pandemic, the global economy screeching to a halt. How's that going to affect the market? Everybody's getting caught up in the minutia of this. Oh, this is going to happen. That's going to happen. All they should have said is, obviously in hindsight, it's 2020, but all they should have said is, it doesn't, I don't know. It doesn't matter. The central banks are injecting an ocean of liquidity into the market. Just buy the market, right? And that was the reality. It was really just one major factor that caused this massive rally for the past, dozen years. And I'm going to argue that it's a natural thought process to think that if you believe that the infusion was a tailwind for asset prices, that liquidity extraction becomes a headwind against asset prices of all types. Again, same asset prices, whether it's stocks, whether it's bonds, whether it's cryptos, whether it's NFTs, whether it's SPACs, whether it's public equities, private equities, whatever it may be. The whole equation has flipped 180 degrees. So we now have headwinds against markets. Doesn't mean markets can't go up and down, as they do, month to month, day to day, week to week. But broadly speaking, we're in a very different regime than we were just 2-3 years ago, and the market prices are reflecting that, and the market price action is reflecting that. And so I recognized that early on. I started, the best macro trade I made was probably starting the fund at the right time. I've been a macro trader for 30 years, so really I was kind of quiet for those past dozen years, expressing my skill set by investing in more niche oriented, arbitrage type hedge funds. So basically, I have, $500 million allocated out to hedge funds. And so instead of trading in the markets, I became an allocator, to hedge fund, niche oriented hedge fund securities. And so, but looking for non-correlated strategies that have inefficiencies and have structural edge to them. So when the environment was very tough and I really couldn't understand it, because I certainly wouldn't have been buying German bunds at 1 basis point, I probably would have been selling them like crazy. And thank God I wasn't participating, because it obviously went a lot further in that direction. So I decided to start the re-engage in macro trading in April of 21, and 21 was really strong. So I kind of eased off the gas pedal. I wasn't really, I got, because what I'm talking about here is I classify it as the white collar part of my job, to just sit here and opine and pontificate on the world. And, but at the end of the day, I'm in the money making business. I'm not in the being right business, and so my investors, I'm a fiduciary of assets, and my investors task me with making money, not with being right. And so, the blue collar part of my job is actually implementing the trades. And we all know that's a very tough skill, to ride this Bronco, where, you can get short the market and then it goes against you. And then you got to, stop yourself out or get bigger, get smaller. There's a lot of, more, I'm going to call it blue collar aspects to the trading implementation, which is really what's the more challenging stuff. What I'm saying, I think this thesis and thought process is shared by some of the smartest, maybe all of the smartest investors in the world. The challenge is, I shouldn't say all, there's plenty of people that have different opinions, but the challenge is actually implementing it and making money. And so we did a good job. I did a good job, I think, of starting the fund at the right time, being cautious at a time, because the S&P ripped, 27% in 2021. So had I just shorted the market, I would have gotten, killed. And instead, I was flat. I was actually up 27 basis points in my macro stuff fund. So, but in 2022, the price action, the trend changed, right? The market started to really go down, and not just the stock market, the bond market, the thesis that I had started to play out. So a guy like me, when your fundamental thesis coincides with the market price action and the trend, that's really the best of all worlds, and you want to go in super aggressively in that regard. And that's what we did. And I think we were number 2 performing hedge fund in the world in 2022, and that's probably why you wanted to talk to me. So that's the genesis, and that's the story of how we started the fund, and we made the money last year shorting the markets, whether it's both stocks and bonds. Nothing much more fancy than that. Certainly I could have gotten involved in emerging markets or cryptos or anything like that. I just didn't feel like I necessarily needed to. I was getting enough satisfaction just being, let's say, involved in the S&P 500 or the Euro stocks, or, the 10-year note in the US, or the short-term interest rates, or the Bund. I really didn't need to get too fancy. I could just focus on the main markets because I'm playing one particular thesis.
Yeah, it's a fascinating story, and it's really interesting how you put together that hypothesis. So if we look at your thoughts over the past 15 years, you'd say the main driver of, I guess, price action that we've seen, especially in the US stock market, has been the liquidity that the Fed has injected into the markets. I guess not just the stock markets, but all assets in general.
All asset price. First of all, yes, no doubt. It's there's no doubt. Okay, it's just as simple as that. There's one story and one story only, and that story is not just the Fed, global central banks injecting liquidity into the system. And I'm sure your viewers can find various charts and indicators. I happen to use M2 just because it's easy, but to show liquidity in the market, and how asset prices performed as liquidity was being infused into the market. And again, not just in the US, but all over the world, because it was a global issue that we were dealing with, pandemic and the global financial crisis and all that sort of thing. So it's the only story. There is no other story. It didn't make a difference what happened to CPI. It didn't make a difference what happened to employment in January of 2015. I mean, none of that stuff mattered. In hindsight, all that mattered is, the central banks were injecting liquidity. And if you just had that one thesis and you said, I'm not going to even care, I'm a trader, I'm an investor, I got to focus on ups and downs. But at the end of the day, I got to just buy the market because central bank posture is towards liquidity infusion. You're probably sitting on a yacht right now, because that was the only story.
Yeah, it's fascinating to think. So if we look at, and I guess normally what would happen is people would say, oh, maybe that's the case for the stock market and maybe other risky assets, but bonds, they're the ones that are going to, they're going to go up and appreciate in value during these recessionary times and during these times of poor performance in stocks. Is it just the same case? It's just this withdrawal of
The same
liquidity
case.
affects everything. Yeah.
Same case. I mean, typically, the natural order of events is, stocks and bonds are negatively correlated. But we didn't see that over the last dozen years. We saw both stocks rally and bonds rally. We had interest rates coming down dramatically, and we had stocks rallying. So you had, people call it the 60-40 model. It didn't matter. 90-10, 80-20, anything that you owned, whether it was stocks or bonds, they went up, right? So, you had this unnatural condition, because it was a liquidity driven story. When the central banks inject that kind of liquidity, investors who ultimately are the recipients of that liquidity have to put it somewhere. And they put it in, first they probably put it in the least risky stuff, maybe the bonds. And then eventually that money filters in to the most risky stuff, maybe like, crypto kitties or certain types of NFTs, or, I'm going to just use, one side of the spectrum might be sovereign bonds, and the other side of the spectrum might be, speculative NFTs, and not to pick on NFTs per se, but just saying that, those are two sort of, so ultimately, probably starts on the less risky side where people, have to infuse the money, but it ultimately filters into everything across the board. So, and it's the same thing. And if you look at 2022, when markets went down, everything went down together, because again, it's a liquidity driven move, and it probably will be for years to come.
Yeah. So if you look at 2023, it doesn't seem like there's the Fed or other central banks have changed too much. You could say maybe Canada and other Australian countries where there's they're more they've got more exposure to interest rates. But if we look at the US, there was thoughts they were maybe pivoting last month. We've obviously seen Fed this week say, Powell this week say no. Maybe we got a bit ahead of ourselves. We're going to continue to increase interest rates, maybe get it more aggressive. We're going to continue with QT. So is your hypothesis going to remain the same going into 2023? Is it that all assets are going to go down, or what are your thoughts?
Yes. So, the bottom line is, you could really drive yourself crazy, with every minutia, attitude that comes out of, the market or the Fed or the central banks. We're gonna go 25 basis points. We're gonna go 50 basis points. We're gonna pause. We're not gonna pause. That's pretty important on very short term type thinking. And yes, it moves markets. And yes, lots of people talk about that stuff. But at the end of the day, to me, that's just noise that relates to the blue collar part of my job, which is trying to manage the bucking bronco of the market, where we get these massive, counter trend rallies, and and then we get some sell offs, and it's schizophrenic. I mean, the bigger thesis is that you've got central banks extracting liquidity, and even if they're not extracting liquidity, they're not adding liquidity. Okay, so that whole story, because even if they stopped, which they're not, there's nothing on the horizon that's suggesting that they're going to stop their normalization and allowing bonds to roll off. And what that means is that those securities need to be purchased and they need to be transferred into private hands. Private investors need to absorb what the central banks are no longer willing to absorb. And so, even if they stop that, they're just not supporting the market by adding liquidity, which is what was keeping the patient alive for a dozen years. And so, the 25, 50 economy is softening. It's not softening. Yes, it's important for short-term trading on a 1 day, 1 week, 1 month basis. But the bigger picture is we're just in a different regime. We're just in a different regime than we were, 5 years ago, right? And that's really what I'm focused on. Obviously, I have to be focused on somewhat more on as well on the short-term stuff, because I got a P&L like anybody, and I got to worry about, being short and the market ripping, like January, market was crazy to the upside. I got to worry about that, and I got to manage that, right? So, but the bigger thesis being that central banks are no longer adding liquidity, and in fact they're extracting liquidity, changes the equation, completely. And so, yes, the answer to your question is more of the same, and more of the same includes, rallies as well, periods of rallying. I mean, in 2022, we had, maybe 3 episodes where we had 500 handle rallies in the S&P from the bottom to the top, these counter trend rallies, 600 point rallies, during this bearish market environment. And so, you know, markets ups and downs are very normal part of trading or investing. There's just, no matter what kind, even in 2008, markets went up and down. I think it was up more days than it was down, actually, if I remember correctly. But so big picture, nothing has changed. We're just getting started. This is a 5-10 year issue, maybe even longer, where you just have central banks no longer being in a position of being the ultimate medicine man to inject the patient with the necessary drugs to support the patient's health, unless we literally fall out of bed to the point where we're in an economic depression or a major recession. But we got 3.4% unemployment. I mean, I'm old enough to remember a day when they thought 5% unemployment was full employment. Now we've got 3.4% unemployment. I mean, we've got 5.5 million service sector jobs that need to be filled. So we're certainly not in a, and I'm empathetic to the fact that there's, a bifurcated economy. You have the haves and the have-nots, and you've got people under some serious duress, maybe because they've been disenfranchised by the technological revolution, and they no longer have jobs, and they've been replaced by technology or robots or whatever it may be. So I'm empathetic to the fact that there are people that are hurting out there. But broadly speaking, the economies are strong, and wages are going up, and jobs are available. They're plentiful. We have 3.4% unemployment. So there's nothing on the horizon that would indicate that central banks are going to have to change this posture of normalizing of what should be normal, right? They shouldn't really be the elephant in the room, where they own all the securities and it's just a completely artificial market owned by global central banks. That's just really not the natural order of events. It should be natural price discovery between profit motivated buyers and sellers that set prices, and that just has not been the case for more than a dozen years.
Yeah, it's really interesting. So you mentioned there that you think we could see like a regime shift potentially. You look at the last 40 years, we've had
not potentially, we've seen it. We're seeing it. Clearly. I mean, central banks are extracting liquidity. It's factual. It's not. I'm not predicting here. It's an observation. It is a regime change. They are extracting liquidity from the system. They are not infusing liquidity into the system. We do have inflation around the world now. For someone who's in the business of in the prediction business, they can predict whether they think inflation's going to come down or inflation's going to stay the same, or it's going to hit the 2% target, or it's going to miss the 2% target, or it's going to go to 10%. I'm not in that business. I have no idea, and I don't really think anybody does either. I'm just not a fan of people that try to figure that stuff out. All I can deal with is reality of what we have today. And it doesn't even matter that much whether it's 5%, 6%, 7%, or 4%. It's a problem, and it needs to be addressed, and it's being addressed. So I didn't mean to interrupt you, but I just wanted to make the point that we are in fact in a regime change.
Yeah, no, that's okay, no problem. So, because I guess a lot of people say, well, they tried to do that in 2018, and then something broke, and then they stopped withdrawing liquidity from the system. So you don't think that could, you mentioned depressing, but could there be something maybe less severe where government pressure or there's some issue in the markets where they have to put liquidity back in, and then it could rip again?
Anything could happen. Anything can happen. Inflation could also go to 20%, and that could happen too. So I can't deal in what ifs. Anything could happen. There's any number of things that could change the whole scope of things. This is a pretty major thing that occurred, and it's going to take a lot to change this. It's like an object in motion tends to stay in motion. It's going to take an awful lot to act upon this new approach that's going to change its course. But is it possible? Of course it's possible. But that's why I say that I'm in the money-making business. I'm not in the being right business, because if people are trying to prognosticate what's going to happen in 2025 and 2026 and 2027, it's an impossible game. There's just too many variables that are going to come up that we haven't even thought about today or in the future that will change the course. But as I'm observing new information as it comes to and not worried about whether initial jobless claims, is 211,000 or 190,000. I mean, it doesn't make a whole bit of difference. But major issues, like what you were, like a, I don't think there'll be a stock market crash, but like a stock market crash, like where we have a 40% stock market crash in a week. Okay, maybe that's going to have to the central banks are going to have to address that. Not so much even because they I think they really want uh market participants to set market prices, but something as dramatic as that will have an impact upon the real economy. And if I'm not suggesting, and in fact, I think the market is a lot safer these days. With the advent of more short sellers in the market, whether it's guys like me or whether it's long short equity funds that have short stocks, and so it provides a natural bid to the market. When markets are going down, you have this natural buffer because you have many participants that are short something. Even if they're running a long short equity hedge fund and they're predominantly long, they still have short equity positions. And the stock's down 40%, they might come in and say, well, I'm willing to buy it back at this level. And so that provides, so all short sellers provide a natural buffer for the markets to dampen volatility when markets go down, unlike the crash of 29, when there was no short sellers in that wasn't a thing back then. And 1987, even, the world didn't have many short sellers. But if you look at 2008, we had a pretty catastrophic market, but it was pretty orderly. We just never had, a market crash, even, last year as well. There wasn't a day or a week necessarily that I could point to and say that this is a market crash. But again, I can't rule anything out, any possibility. So, that would be the most likely scenario if we had a stock market crash to the tune of 25, 30, 40%, maybe the central banks would have to respond to that because it would be causing real distress in the system. But that's, as speculative as an alien aircraft is discovered in Roswell, New Mexico tomorrow. I don't know. Anything can happen, I suppose.
Yeah, definitely. So you mentioned you got this hypothesis, and obviously you wait until you see the price action, and then you'll enter position. Are there any other things that you're looking at rather than just short everything? Is there anything else that you're keeping an eye on at the moment?
Well, I keep an eye on everything. It's really the price action. The thesis is not something that I think a macro guy like myself and others in my brethren, we don't change our minds like on a daily basis, based upon like a number here and there, or even an important number like a CPI number or employment number. I mean, the broader thesis is not going away, without a lot of something severely catastrophic happening to make me or somebody else reevaluate that big thesis about central bank liquidity flows. But naturally, again, I'm in the business of managing money for other people and also for myself, and I have to deal with risk management, and I have to deal with maximizing my gains when I'm winning, and I have to deal with minimizing my losses as best I can when I'm losing. And so I have to be sensitive to risk management and price action, and what the consensus is for tomorrow's employment number, and what the consensus is for the upcoming CPI number, and what the consensus is for the upcoming FOMC meeting. I got to be aware of what's going on and all that stuff. But other than managing risk to that, not take it all that seriously, because it's not really going to change no matter what happens. It's not really going to change the picture of the larger thesis that's a multi-year thing, in much the same way as I described very early on, is that when the central banks were infusing liquidity into the system, basically that was the one and only thing that was really relevant. I mean, yes, markets went up and down and had their nuance moved based upon economic statistics at the time, but if you look back on it, you really did pretty well just kind of buying the market when it was down, and for whatever the reason, just focusing on the one thesis that the central banks are adding liquidity. So it doesn't really matter what is causing that counter trend move. I have an axe to try to fade that counter trend move and go with the longer term trend, which at the time happened to be up. I wasn't playing because it was hard for me to understand what was happening. It was really in hindsight, obviously we see what happened, but I never in a million years would have dreamed that we would have had $19 trillion of sovereign debt trading at negative nominal interest rates, not real interest rates, like below zero, where you had to pay the government to take your money from you. I mean, there's just no rational explanation for that. So I was fortunate that I didn't participate in that, because I wouldn't have understood that, and I would have probably lost some money in that. But that was the right way to be, is to just say it doesn't make any difference how crazy the prices are, or any semblance of valuation, or any economic statistics that are coming out, or any chatter from the Fed. What matters is that they're adding liquidity, and I would just argue that the inverse is true today, is that is the elephant in the room that really matters. But obviously, we're all dealing with monthly P&L and performance metrics, and so we have to be a little bit focused on more shorter term issues and managing risk and that sort of thing.
Yeah, that's really interesting. So, Neal, thanks again for your time. I really appreciate it. Just my last
Right.
question is, what is one message you'd like people to take away from our conversation?
Um, I think the one message is that people should really be introspective, and instead of looking at when are we going to go back to normal, and their normal was 3-4 years ago or 5 years ago. The reality is that was abnormal. That was the anomaly. We will probably never see that again in our lifetime. I mean, I hate to say never, because I traded in the dot-com craze in the 1990s, late 1990s, and that was pretty nutty as well. But those are the abnormalities. What we're seeing today, and we haven't even gotten to the point. You still have U.S. 10-year notes at 4%. I mean, that is just not. It only looks like it's a great deal because it's coming from 70 basis points. So everybody's got recency bias. They're like, wow, it went up a lot. Let me buy this thing. But the reality check is it's 4%. And we got inflation running over 4%, and we've got Fed funds at over 4%. And it's not always, just a very short-term condition. And okay, as soon as the central bank stops tightening, all of a sudden they're going to start easing. So, I would urge people to think about things. I could be wrong, of course, but that the recent 10 years was not normal. That was abnormal, and we're starting to go. And I think we're really just in the early stages. I mean, a 7% 10-year note is not abnormal in historical terms. We're at 4 right now. A 6% 2-year note is not abnormal, and that's without inflation, really. And so those are not abnormal figures. And so what I would say is that what we saw in years past was the anomaly, and we're moving towards what is really the more normalized condition over the historical tenor of market history.
I like that. It's not a new normal. It's just back to normal after the
Right,
madness.
exactly.
Really
Right.
interesting. So, Neal, thanks again for your time. So if
Pleasure.
anyone wanted to find
Pleasure.
out more about your work, where would best places to be for that be?
You can email me, nberger@evhedge.com. It's you can find me on the internet, Google me, hit me up on LinkedIn, whatever, and happy to chat with people.
Perfect. I'll put that in the description below. But yeah, thanks again for your time.
Okay. All right, Anthony. Thank you.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.